Hi there, welcome to Kneppy Invest and welcome to the first day of August, which is the last month of winter. And I'll be honest with you, around this time of year, I am wanting a little bit more warmth in my life. I'm over the winter months, I'm over the cold. And luckily enough, in Brisbane, we can have warm August. In fact, back in 2009, we had a day of 35 or 36 degrees. I think that was around Eka, which is the Brisbane show. I've never been to Eka, by the way, and you couldn't even pay me to go to Eka, but that's just me. I don't like those sort of things. Anyway, first day of August, my favorite month of the year in terms of investing and probably also in terms of overall life because we are moving towards spring and spring might be my favorite. It might be my favorite period of the year for various reasons. Anyway, pretty good day on the market. I'll talk about what happened today. And also, I was a little bit flippant about the market yesterday. The ASX was up about 1.7%. And I'll discuss why. I mentioned it briefly, and we also had a really good day on the American markets. My portfolios were up huge because of the Nasdaq. I believe the Nasdaq was up 3%. And one of the things I don't like about the American markets is how I was going to say volatile it is, but it's just so fickle. I think I mentioned that word a few times. It can be really fickle. Just look at Nvidia, down 10% yesterday, or nearly 10%, up 12% today. Just that fickleness. Let's have a look at Nvidia. No, won't have a look at Nvidia. Anyway, so a lot of that enthusiasm has sort of flowed through to the Australian markets today. Now, I will discuss why we had a good day yesterday in terms of inflation and why the Nasdaq was up pretty good overnight as well. I'll probably show you a few tweets. So those tweets were important. And I did have some time to look at Twitter this morning. Yesterday, didn't have any time because of how busy it was. And in terms of how busy it is, only 99 price-sensitive announcements have been released today so far. Time is 2:47 p.m. Yesterday, there were 737 price-sensitive announcements. Now, I don't go through every single price-sensitive announcements, but I do go through quite a few of them. And overall, there was 1,100 announcements released yesterday. Today, probably 400 or so. Now, in these 99 price-sensitive announcements, I have come up with 5 announcements that were intriguing or interesting. So they are my top 5 stocks of the day. Few companies did not quite make it into that list, but I will talk about those companies briefly. And that's after we do the ASX Today, looking at the best and worst performing sectors, indices, and also companies. And then I might have a look at either some charts. Have no charts lined up for you right now, but I also want to have a look and answer and reply to some of your comments, and hopefully I will have a bit of time for that. Now, I haven't got Twitter opened up just yet here, so let's do that right now. Let's open up Twitter, because I did actually bookmark a few little comments. Here we are, bookmarks a few comments. One from Warren Hogan, and this is written yesterday or released yesterday. Inflation, and one of the reasons I was a little bit flippant about the markets yesterday and inflation were they all met expectations. There was no surprises there, but there was an interesting tweet from Warren Hogan. Inflation at 3.8% on RBA forecast, but core a touch higher at 3.9%. Market, we're looking for a smoking gun on core inflation above 1% in the quarter to trigger a hike. The implication is that because it came in at 0.0843%, the case for a hike has disappeared. If only it were that, well, this does go on. Where is it? If only it were that easy. The RBA board does have an excuse to remain patient, may well do that. But as the broader picture has not changed, inflation has stopped falling in Australia in 2024 at around 4%, with fiscal stimulus hitting the economy and employment growth super strong. There is material risk that inflation remains at 4%. And he just goes on and on and on. I don't think there will be a hike in interest rates, and I still think that will be a significant mistake. So I'm a little bit different from Warren Hogan here. I don't think the economy is that strong at all. Even though unemployment's fairly low, I don't think the economy is that strong to really have an argument for us raising interest rates, for there to be an argument that we should be raising interest rates. And there was another really interesting tweet that maybe actually had a look another look at what happened on the markets yesterday was exchange rates. This is Australian dollar versus US dollar, and around the time they released the inflation numbers, it completely collapsed. Anyway, so that made me have a closer look at the Australian markets, and yeah, there was a bit of a rally at 11:30. I'll show you that in a second. Okay, so those are the two tweets. Not a lot there, but it did make me have another look. So let's have a look at the ASX. Actually, no. Before we do that, let's have a look at the XJO. So this is the 5-minute XJO, and right on 11:30 yesterday, the XJO rose 0.6% in 5 minutes. In fact, if we hone in on the 1 minute, I would expect it was, yeah, there was a massive rally right on, well, that's 10 o'clock, and where's 11:30? And that's today. Oh, silly Michael, that was today. And yeah, right on 11:30 when the inflation numbers came out, the XJO went up 0.4%. Might not seem a lot, but that's in 1 minute. 1 minute. So there's definitely a bit of a signal there from the market that the inflation numbers were a little bit weaker than they were expecting. And we know that because the market really liked what they saw and read, and now the expectations of an interest rate hike are probably much lower. And then overnight, there were mentions, I did see some few tweets about this, that there's more likelihood that interest rates might drop. Therefore, Nasdaq up 3%, Dow Jones only up 0.24%, and companies like Nvidia were up huge. Let's go to my portfolio. My portfolio had a really good day. Nvidia up 12.8%, TSM, Taiwan Semiconductor, up 7.3%, and Facebook, or Meta, released their results, and in aftermarket trading, the price of Meta was up about 8%. And I just saw one tweet saying their results were really good and their expectations for the next quarter are really good as well. So pretty good day. Microsoft was down because their results were a little bit weaker than expected, but only down 1%. There were fears share price of that company might have dropped 7%. They might have if the day was weaker. So really good day. I'm pretty sure PayPal released something really good the other day as well, because the share price has just taken off the last 2 days. So I haven't had a look at that. This is actually my longest holding, American holding, PayPal. And I think this is absolutely dirt cheap, but this particular video is not about PayPal. So let's have a look at the ASX today. Another good day, particularly tech and mining. Both of those are up by over 1%. So let's have a look at the sectors. Two sectors down, industrials and financials. Interesting there. IT 1.9%, real estate 1.86%. So REITs and Goodman Group, those sort of companies are going on a bit of a run. Maybe REA Group as well. Energy, materials, utilities, all up by more than 1%. And banks have had a pretty down day. ASX 200 banks down 0.39%. So as we have a look at the ASX 20, probably a good guess would to say at least 2 or 3 of the major 4 banks are down today. And I'd say WiseTech's had a good day, Aristocrat, REA Group, Goodman Group, Woodside, Santos, all the mining companies had a good day. So let's have a look at the ASX 20. I'm going to guess now, 5 companies down, 15 up. Let's have a look. Oh, close, 16 up, 4 down. And I'm going to guess right now, without even looking, 2 of the major banks are down, and then I have no idea. Well, we'll say 3. Oh, close. NAB, CBA, and I suppose QBE Insurance is financial. Would that be classified as financial? Financial, yeah. That can make sense. And then Transurban, and the best performing companies in the ASX 20, Goodman Group, up 3.8%. Rio Tinto, Woodside, there's WiseTech, Woolworths, Aristocrat, PHP, Fortescue, and so no surprises in those top performers in the ASX 20. Okay, so let's turn our attention to the best and worst performing companies. Might get a few surprises here. Hopefully a few of my companies are in this list. I am confident one of these companies is in the worst performers. Anyway, so let's have a look. Atomos, up 52.7%. Market cap is now 66.75%. When did they release their Appendix 4C? I'm pretty sure it was yesterday, not today. Yesterday at 6:21 p.m. after the market had closed. So obviously the market likes Atomos. And I didn't even think about including that or any other companies into my top 5 stocks of the day. Let's have a look at Atomos. is this a reason to get excited about this company? So, okay. So I didn't even have a look at this. All I had a look was the numbers, and I moved on to the next one because company is operating cash flow negative by 4.8 million, receipts 10.1 million. I didn't think this would really trigger happy thoughts within the investing community, but it has. Anyway, so the market likes this. Atomos share price has risen, and let's have a look at the chart. Is this a breakout? They were in suspension for a long period of time. So they were put into suspension on the 27th of February 2023 and came out on the 21st of May 2024. Share price on that day closed at about 2 cents. Share price now is 5 cents. So if you bought on that day, you've doubled your money in a fairly short period of time. So this is looking interesting, but the share price at one point for this company was over $1.50 back in 2021. Companies has gone through troubles, and for this particular company, what I'd be waiting for, this is just me, I'd just be waiting for further proof that the company can become profitable, and we just haven't got that just yet. And to be honest with you, if the share price keeps on running, I've missed the boat. So that's Atomos. Bravura Gold, didn't include that company in my top 5. They did release some sort of, they hired a professional miner or something like that. It was an interesting one. And again, I didn't really expect the share price to rally like this. Experienced mining professional appointed. That was it. They also released their Appendix 5B at 4:12 p.m. I didn't have a look at this. Didn't even open up. I don't think this company is in production. I'm pretty sure they're not. But let's just have a look. Bookings. And yeah, they're not in production, no. So I would assume the share price rallying is on the back of this mining professional appointed, and maybe it's a very well-known name in mining. But I don't know any names in mining, and I doubt the people I do know in mining would be appointed for Bravura Gold. Anyway, yeah, Bravura Gold has a market cap of 35.96 million. Most of the other companies on this list. Oh, there's Clearvue Technologies. I have included Clearvue in my top 5 stocks of the day at number 2, and I'm very happy. Share price is up 15.9%, particularly for any shareholders who held strong to that company. A very interesting tech. I've mentioned Clearvue a few times before. I am not a shareholder, so I don't mind not praising, but talking about how intriguing a company is based off their technology, because I'm not a shareholder. I can do that. Our market cap is 123 million, but I'll talk about Clearvue Technologies later in the video when I talk about the number 2 stock of the day. And otherwise, nothing of note elsewhere. Let's have a look by market cap. ZIP's there. ZIP. I did get a question about ZIP from Liam Jones. I might talk about this. It's ZIP and SPPs. So I will talk about that at the end of the video. Pacific Smiles had an altered takeover bid or something. OneView, Colso, very happy. Appendix had another good day, 3 good days in a row. I think probably overbought right now. And a few other companies whose markets or the charts look fairly interesting, including Structural Monitoring Systems up 12.88%. I don't think I'm quite there yet with that company. All right, so let's have a look at the worst performing companies. And I expect at the top or near the top should be Droneshield. There it is, down 15%. And that is my top stock of the day. I'll talk about that company in a second. Otherwise, most of the companies on this list are either really small. Actually, they're all really small. All the companies that had worse day than Droneshield have a market cap below $20 million and on really low turnover. If you just look at the turnover, Droneshield, 46.6 million. Then the next highest turnover above them, Torque Metals, $298,000. And some companies here are on a turnover less than 1,000. In fact, 5 of them. So very illiquidly traded companies here. I do wish there was a filter that you can sort of weed out the low turnover companies. But I suppose I could do that manually right here. Otherwise, nothing of interest there. So just Droneshield, and by market cap, Droneshield, OFX Group had their AGM. Not sure why the share price is down. Some of the other companies have no idea. Just a bit of noise, I would assume. Max 7 had their Appendix 4C the other day. I thought it was quite good. Anyway, I think that's it. So let's get to the top 5 stocks of the day. I'll just briefly mention 2 companies that did not make it at the end, once we talk about top 5, and then I'll look at the comments, answer some of your comments. So let's get stuck into it. And coming in at number 5 is a REIT. In fact, the only financial results that were released today. Well, half-yearly results. There are a few stragglers who released their Appendix 4C and 5B. Sometimes you will see that on the morning of the first month after the last day of the first month after the end of the quarter. Oh, the mouthful, that one. So Garda Property Group, share price up 1 cent today, released their results. So a lot of stuff happening here, a lot of 5 documents, in fact, or announcements. Appendix 4E, annual financial report. Appendix 4G, corporate governance statement. Property book, and a results presentation. I'll be honest with you, I did not open up the Appendix 4E, financial report, Appendix 4G. I just opened up the presentation and the property book. So let's do that. Because I think it's probably wise, maybe not wise, it all depends on your own investing philosophy, that sort of thing. But I think a lot of REITs there could be some value there. And I always have a look at how much of a discount they are trading to NTA and what sort of property they're into. So the main ones are office, retail, industrial. There's no property one, no residential, is there? Is there any residential REITs? I have no idea. In fact, if I was buying a REIT and there was residential REITs, I'd probably be most interested in that. But excluding any of those potential residential REITs, definitely no interest in office REITs. Definitely not as much interest in retail. The only sort of REITs I would be interested in are industrial. And I have no idea about Garda. But it's a REIT. It's definitely a REIT. And why it's a REIT? It's got up here. Equity Real Estate Investment Trusts. REITs. Anyway, I'm just waiting for, this is a presentation. Okay, so I opened up 2 documents, is the presentation and the property valuation. I just want to see where they have property and what sort of property they're into. And just by looking at this particular document, portfolio overview, just based off the geography and sector by value, they're mostly Brisbane. 83% just in Brisbane, 17% in Cairns. All their Brisbane, seems like all their Brisbane property is industrial. All their Cairns property is office. Tenants, Volvo Group, Ausdec, Komatsu, Pinkenba Operations, Queensland Government, James Energy, C&W. I don't know the quality of some of these particular tenants. I suppose Volvo Group is quality. Something else I like to look at is just when their leases expire. So 4.8 years portfolio WALE, which is weighted average lease expiry, 94.4% portfolio occupancy. Is that good or bad? I don't know. I'm not an expert in REITs to know if 94.4% is high, but I would assume if it's 98%, that would be pretty good. And I have no idea what portfolio cap rate is. Let's go now to I'll have a look, go back to that document, and I'll just talk about, and first time I had a look at REIT was 2 years ago. So I did a little bit of work on REITs just to know what I should be looking for. So yeah, they've got here 83% industrial, 17% office. We already know that. Portfolio value is 509 million, which is interesting because the company has a market cap, I think it was 200 million. 251 million. So they would have a fair bit of debt, which makes sense. REITs probably have a lot of debt because property only makes sense if you're in debt. Anyway, because the yield on property, if you're not in debt, it's pretty low. Okay, so the things I look at here. NTA per security, $1.71. And the share price of this company is $1.15. So it's trading at a fairly significant discount to the NTA. In fact, if the share price if the share price went up 50% from here, it would be getting close to the NTA. Now, the NTA could fall from here because I'm pretty sure it did drop from last year. Another one thing I look at is gearing, 36.5% gearing. So, of course, the lower the better. I'm not sure what gearing level is getting too high. I did see that with Charter Hall Long WALE REIT about a year ago, and I remember thinking, oh, that gearing looks a little bit high. Complete exit of Melbourne office portfolio at a 21% discount to book value. Well, at least they're getting out of office. So it seems like they're now honing in just on Brisbane, which could be a good thing. I think Brisbane, or this area, Southeast Queensland, is a boom area, not in only Australia, but probably the world, an area you want to be in. And okay, so exit from Melbourne office, yep. Increased lending. What's this? Garda performance, ASX discount to NTA. So they're just saying, we're cheap. This is a reason to be excited about us. We are cheap compared to our peers, and they're industrial, which I don't mind. What's this? Garda implied value discount, $1.71 per security, a 33% discount to NTA per security. Yep. What else? Gearing has been stable the last 5 years at around about or between 34 and 38%. NTA per security climbed rapidly from $1.18 to $2.05, but has dropped the last 2 years. In fact, it dropped from $1.96 to $1.71. Payout ratio, you'd assume that's going to be around 100%. And whale has been dropping. Not sure if that is a concern. The other thing is the FFO, which is the financial. Actually, I don't know what it is. FFO is funding financial. I don't know. Anyway, distributions is the dividends. FFO is for. I'm just going to Google it. I did actually know this. Funds from operations. Yeah. So it's sort of like, what's a good word? Is it would profit be a good word? They've got net loss after profit, but I wouldn't look at profit or loss of a company because it all comes back to valuations. And if there's a revaluation of the property, that could be significant for their profit. It will be significant for the profit. So funds from operation, which is, I assume, it's leases and stuff like that. That's probably the most important thing. And distributions with is dividends should be nearly the same as funds from operations. For Garda, not quite there. So distributions per security, 6.3 cents, down a little bit from last year, which was 7.2 cents. So this company does have a dividend yield or a distribution yield of roughly 5% something, 5.6%, which may not be high enough. A fair bit of debt. Companies like this are going to always have debt. So they have net debt, seems like, of about $200 million, which means they have $200 million, which means market cap is 250, so enterprise value of $450 million. And I suppose you could go through all this. There we are, NTA per security, $1.71. How they get to that? Well, they get that through the balance sheet. So total assets, 565. Total liabilities, 223. So $216 million of borrowings, investment properties, 495 million. So net assets at 342, which is $1.71 per security. There we go. I think that's what I'm going to talk about when it comes to Garda. Just have a look at some of their property. And there it is, a map of where they have property in the southeast Queensland. And it seems a lot of it is to the south of Brisbane, which sort of does make sense. I do, and I live on the northwest side of Brisbane, and I do consider the southwest part of Brisbane to be more industrial than where I live. Definitely more industrial. So Piggenbar, Morningside, Wacol, Berrinbar, never heard of Berrinbar, Heathwood, Wacol, Richlands. So go through this if you like REITs. So maybe this is, maybe there is some value in Garda. Let's have a look at the chart for Garda. What is it ticker? GDF. Let's have a look at the chart, and yeah, the chart looks pretty ugly, but maybe it's value. Look at the weekly chart. Yeah. So possible value with this company right now. Do I have this in my REIT? I don't. I don't even have this in my REIT watch list. So this is the first time I've ever had a look at Garda Property Group. And yeah, not the sort of company for me, but if I do see some value, maybe, just maybe. Okay, so that's coming in number 5. We have GDF. Coming in number 4, company I do own, Findi. Oh, for share price is down. Fair bit of volatility today. Share price opened at $4.13, went to a high of $4.40, went to a low of $3.85, is near the low. So a little bit of volatility. So the company or the market is not quite sure what to make of their financial year 25 guidance and market update. I won't look at the presentation. So this company owns like ATMs in India, which is a growth area. And I think they want to do other stuff as well. So their guidance for financial year 25, revenue of 80 to 90 million, which is a nice increase from this year. This year, it was 66.5 million. EBITDA of 30 to 35 million, which was an okay increase this year, 27.54 million. But they've also mentioned, and they mentioned this quite a bit, that their expected EBITDA will be impacted by their strategic investment in accelerating the Findi Pay rollouts. This is not ATMs. They also have these other paying methods for Indians, systems rollout, and expanding the C-suite team. So they are spending a little bit of money for future growth, to get that future growth. So let's try to point that out. This is something that they are doing, spending their money for growth. In fact, if you do have a look at their presentation, they did have a nice little graph. I wouldn't say it's trickery. It's not really tricky, but they didn't really point out that any financial year 26 numbers, but there was a nice little, see if I can find it here somewhere. Here it is, this one here. So financial year 25 guidance, and then put this sort of blank bar, financial year 26. And if you do extrapolate, which is probably the wrong way to do this, you could suggest or argue that Findi is suggesting that revenue is going to double in financial year 26, and even EBITDA might get close to doubling because of this little bar next to it. So in a way, they have put a little bit of a forward forecast into this particular announcement. So I do think and understand why the market is a little bit unsure. The market sometimes can be fairly narrow viewing. They only look in the short term, but some investors look at the longer term and they think, oh, I don't mind if a company's spending some money now for future growth. And the chart, well, that's the weekly chart. Let's have a look at the daily chart for Findi. Had been looking like a nice little bounce. 2 really good days in a row, up about 20% in 2 days. And yeah, there has been a little bit of selling. Let's have a look at the 1 minute chart today. Yeah, there was some buying on open. Share price reached a high at 10:10 a.m. And since then, we have seen a bit of selling. Not a lot, but a little bit of selling. And share price has pulled back. I do have a position in this company. I have no intentions of selling that position because it was profits. That's all profits. Because I bought this company many, many years ago. I added to my holding on options. I exercised my options at 90 cents. That was in January this year. And the share price has quadrupled since then. And I can definitely understand why there might be a little bit of selling. Profit taking. I've done that. I did that with Findi. I took profits. Anyhow, is the company cheap or expensive right now? Well, if you're doing a DCF for 5 years, 10 years, and they continue to grow like they have been growing, I think there's an argument this company is fair value to really cheap. But there's a lot of possibilities. That's one of the reasons why I don't like doing DCS, because particularly for growth companies, the possible outcomes are significant. It's very wide, and the DCF number you come out with is going to be nonsensical, really. The only times I would even think about doing a DCF is for mature companies that are not growing or very little growth. They just grow at the same rate every single year. A DCF for those companies, it makes sense. But for every other companies, no. And I've seen people do DCFs for high growth companies, and they come out with this company is significantly overvalued, and just go, well, you're putting in really low growth numbers. Be realistic. And they go, well, I need a bit of a margin of safety. Well, if you do use margin of safeties like you used, you will never buy high quality companies, because typically high quality companies have a higher valuation or premium attached to them. So stick to your low quality companies that look cheap, and you probably won't beat the markets. Anyway, little rant over. So that's Findi coming in at number 4. I always like guidance and market updates, particularly for companies I own. Even if the share price is down, who knows? The share price could be up 5-10% tomorrow. Another company I think is really cheap. Share price is up 9.1%. Financial or fourth quarter 2024 trading update, growth and strong loan balance. MoneyMe. Many companies in this space have been destroyed. So MoneyMe has a market cap of roughly 67 million. Pretty sure it's profitable. The chart is ugly or has been ugly. I am waiting for companies like this to turn around, and they should really benefit from lower interest rates. So this is a lender, a personal lender, for higher risk, maybe not high risk individuals is maybe saying that is not fair, but their net interest margins are really high. So there is a little bit of risk attached to the loans this company produces or gives to their customers. I would say it's fairly low. So maybe cars at the max, definitely not property. So cars. And someone did mention in it was Ausbiz.com over a month ago about MoneyMe, and you just knew this person didn't understand MoneyMe at all, because I started talking about mortgages, and I'm pretty sure this company doesn't do mortgages. So they're not in competition with the big banks. Almost certain about that. But this person just talked about how there's so much competition in mortgages in this space, and I was like, oh. Anyway, I won't talk about that person. I do know who it was, but anyway. So let's have a look at MoneyMe. Why is the share price up? Is this a potential breakout? So loan originations increased 165 million, up 25%. Gross loan, I'm not even sure what numbers you really need to look at here. But gross revenue of 54 million, which is fairly flat from the last few quarters. Net interest margin, I wouldn't look at this, 10%. So if, and it's a big if most of the customers pay back their debts, that's a pretty good interest margin. Banks on their mortgages have really low interest margins, like was it 2 to 3% or something ridiculous like that. So 10% is really nice. Net credit losses reduced to 4.5%. Increased credit quality of the loan book drove lower provisions. What else is here? I was trying to find something about the average loan. They do loan for cars up to 150,000. Okay. And yeah, it's probably all I'm going to say. I just want to see some commentary. Didn't have a look at the commentary. So they are pleased, this is according to the Managing Director and CEO, they are pleased to present their fourth quarter results. I've seen sometimes a CEO or whoever say they are pleased to give you these results when the results are terrible. The share price drops 30%. So use the word please sparingly. Don't always say it when you're releasing terrible results or terrible news. Finished the year strongly and marks our return to growth. Okay, that's interesting. So they have not been growing. I'm just looking at these little graphs down here. Yeah, I can see that. Yeah, nice little growth in the gross loan book balance and originations. We have navigated the high interest rate environment effectively, achieving a profitable outcome that we look forward to reporting in our full year results. Company's profitable. Talking about low originations growth. Okay, talking about the benefits of credit quality. And credit losses. Average credit score now sits at 763. I'm not an expert in credit scores or anything like that. The one thing I was looking for is just the average debt. And I haven't seen it here. Doesn't mean they don't provide it. But I would like to see it. What is their average debt? I would assume it's fairly low. And they're going to release their results on the 29th of August. Anyway, the market likes it. Oh, here we go. Maybe you can see it here. Maybe the average, maybe they just don't do that sort of thing. Average loan. And they have, 5 quarters of history here. And that's it for MoneyMe. So let's have a look at the chart. And I am following this. Actually, I'm not sure if I do have this company on any of my significant watch lists. Let's have a look. Yeah, it's in my 20 for 24. So this is a company I think could turn around, because they do seem quite cheap, and it's also in my financials, which makes sense. Okay, so share price, massive funk. Share price of MoneyMe was as high as $2.40 back in 2021. A well-defined downtrend. I think the share price is basing. It's consolidating, going sideways. waiting for a breakout. I think we are heading towards a breakout with MoneyMe. I put these little, I'm going to just extend that line. That is the line or the highs we saw, the share price of this company saw in January of this year. So that is over 10 cents. So I was trading this back here, and then I was thinking it could get above 10 cents, and it didn't. It could get there now. It is starting to look a little bit stronger. Today is an interesting one-day candlestick. Sort of reminds me of the candlestick back on the 1st of December, and then it went on a nice run. This could be an interesting trade. What's the volume? Oh, the volume is really weak. Not high volume. I'd like to see a little bit higher volume. Volume is only 1.6 million shares traded. We had 6.4 million shares traded the other day. It is a little bit higher than average, but on occasion there's these big spikes in volume, which could be a fund manager. Anyway, share price up almost 10% today. And these are the sort of companies I am looking at. There's quite a few companies in this space, and this is just one of them. So that's MoneyMe coming in at number, what is it? Number 3. Coming in number 2, we have Clearvue Technology, share price up 14.8% on a pretty good announcement. I like this announcement. It's not my favorite type of announcement, but the market has spoken, up 15%. Clearvue Science, Alutech, Qatar's largest glass manufacturer. Now, the technology of this company is intriguing. One of the reasons it's intriguing to me is because I don't completely understand it. Photoelectric or something like that. So this is the case of, if you want to invest in this company for the long term, probably understand the technology first. And I would not invest in this company for the long term just yet, but that's just me. So let's have a look at their technology. I think I've mentioned this before. Operates in the building integrated photovoltaic sector, which involves the integration of solar technology into building services, specifically glass and building facades, to provide renewable energy. It sounds really interesting. So it does sound interesting. Clearvue's electricity generating glazing technology is strategically positioned to complement and make more compelling the increased use of energy efficient windows. Yeah. Anyway, so if that sounds interesting to you, have a look at their website. Have a look at this announcement. They did release their Appendix 4C recently on the 10th of July. So the company is still, I would call this company still a story stock. Main reason it's a story stock is if you have a look at the cash receipts, only $131,000 of cash receipts in the quarter, $151,000 for the year, and still burning through cash. So in my opinion, still a story stock, and story stocks could go any way from here. Just because they have really interesting, intriguing technology does not mean they will make it in the end. I'd say most companies at this stage, where Clearvue are right now, don't make it. A few do, but some don't, or many don't make it. So it's all about your risk tolerance. Really interesting technology, and I am following this company more, and I hope they make it because it sounds amazing what they're trying to do. But again, doesn't mean they will make it. There could be a competitor out there who has the same sort of technology, who's doing better stuff. I just don't know. That sort of thing. I haven't taken a closer look. Chart was looking interesting, but it's all over the place now. I would not say this company's share price is an uptrend just now. This is not a breakout. So I wouldn't even say it's close to a breakout. If the share price hadn't risen from the 24th of June and the share price was now about 54 cents, I'd be more interested in this. So I had traded this. I thought this could have been a breakout here, and it was pretty obvious it was failing. And then I got out, and then someone wrote a comment saying, you got into Clearvue too early or too late. And they didn't realize that you can sell shares if you buy shares. Yeah, some people don't believe that you can sell shares when you buy shares. Anyway, so definitely Clearvue is on my radar, and I really hope we start to see some really good growth in their receipts, revenue. They move towards profitability, because I'd love to buy this company for the longer term. Anyway, so that's Clearvue coming in at number 2. Coming in at number 1, our favorite company. Well, I'm saying that not flippantly. Droneshield down 14.4% on the back of a capital raising. This is interesting. So the capital raising was done at a share price of $1.15. Share price opened at $1.15. Oh, wow. What? How that? Yesterday it closed at $1.39. Not yesterday, the previous trading day. Share price went to a low of $1.12. Not sure why you would sell below the capital raising price. Now, this was a placement, so no SPP, share purchase plan, or whatever that's called. Probably the most interesting thing about Droneshield is this is a second really big capital raising in a few months. Now, I'm not saying they should not have done this capital raising. Now, share price had gone on a run, and ideally, they should have done this capital raising 2 weeks ago when the share price got to $2.70. You could have done it at a maybe 5% discount, and you would not have diluted shareholders as much as you are doing right now. So there is definitely an argument to say this capital raising was badly timed, slightly badly timed, because there is a bit of dilution here. Now, they are raising. Here it is, capital raise of use of funds, R&D, 90 million, acquisition funding, 20 million, working capital and other offer costs, 10 million. So they're really dumping a lot of money into R&D. And the question becomes, can this research and development lead to significant revenue generation in the future? So that then means that your trust in the management of this company or the technology officer is very important. Do you have a lot of trust that they can turn this research and development into significant revenue and profits in the future? Because this is a pretty big amount of money. And not only that, second big capital raising done in a few months. Now, this, I think, is just a placement. So there's no capital raising for shareholders. Is that right? Okay. Yeah, it just says trading halt. Trading halt, proposed capital raising, and then just a placement, underwritten placement. I could be completely wrong, but I don't like that. I don't like placements. I don't like when shareholders can't participate. In fact, I hate that. I really, really hate that. I think when you do a capital raising, shareholders should always be able to participate. I understand placements are quicker, but I think you could have given this to shareholders and they wouldn't have taken much of a discount. Maybe I'm being a little bit naive in saying that. Anyway, that's just me. So that's Droneshield doing a capital raising. Share price has dropped because the capital raising was done at a discount. Was a 10% discount, $1.39, maybe about 15% discount. And of course, if you have a look at the chart for Droneshield, what can you say? They should have done the capital raising 2 weeks ago. Yep, 2 weeks ago, almost to the day. If they announced a capital raising on the 15th of July, share price closed on that day at about $2.60. I reckon they could have done a capital raising at a share price of $2.50, and I think they would have had a lot of takers. There is a possibility. One of the reasons why the share price might have absolutely dropped on the 16th was because of loose lips. Maybe someone out there knew the company was going to do a capital raising, and that was the species ending event for Droneshield. That sort of one day capitulation share price is a really bad sign. And then they released their Appendix 4C. The market didn't like that either. That was last Monday, 22nd of July, I think. Share price fell 20% on that particular day. And share price has been going sideways. A lot of volatility in there, but going sideways since then. Massive volume coming in. Beautiful chart up until 2 weeks ago. Yeah, 16th of July. So that's Droneshield doing a capital raising. Is now a time to get into Droneshield? I have no idea. I'm staying completely out. Sometimes when a company does do a capital raising like Droneshield, I'm sometimes a little bit more eager to get in. Maybe not eager is the right word, but I'm more likely to get in if they don't do it because I know now they probably won't do a capital raising for a while because there's no way they're going to do 3 capital raisings in a fairly short period of time. Market cap of this company is still about 900 million, although that should increase with the capital raising. Anyway, so that's all I'm going to talk about when it comes to Droneshield. There's the share price down here. Yeah, it's actually in the support zone. Yeah, I don't know. Yeah, it's the reason why that's actually interesting level. See this little pop up in the share price back 17th of April. Wow. And the share price pulled back after that. Was that a capital raising? That could have been a capital raising too the next day. Can't remember when that was. So let's actually, 17th of April. Let's go back in time. 17th of April. Yeah, capital raising, 18th of April, the day after that pop-up. That's actually a pretty good time capital raising, exactly when you should do it. So we're talking about 3 months ago. It's not that long ago. And the share price right now is at the level it was the day before that first capital raising in April. Right on that level, which is $1.12. So just a bit above that level, but you know what I mean. It's right at that level. So it is a support level, around about $1.12. So just based off that, maybe I could see a trade with Droneshield. Now, talking about Droneshield, or actually talking about capital raisings, FBR, they're doing capital raising, going to trading hot for a capital raising, and I think is this a pretty good capital raising? Maybe. Share price has been on a tear, a really nice bounce off the short-term moving average channel. Share price fell a little bit yesterday, but definitely share price is a much higher than it was not that long ago. It's more than doubled. This is when you should do a capital raising. When you see the share price rally like this, yeah, you could argue that when management think the share price or the company is overvalued, that's when they do a capital raising. And there is evidence that that is the best time to do a capital raising when the company is overvalued, because it's actually better, less dilution, and you're raising money at a better value. Sort of like you should do a share buyback. Management should do a share buyback when the company is undervalued. Do a capital raising when they're overvalued. Do share buybacks when it's undervalued. And if you keep doing that over and over again, you create significant value for your shareholders. That's all you have to do to create significant value for your shareholders. Just do capital raisings when you're overvalued, share buybacks when you're undervalued. And I wonder if anyone's done that before. Probably not. And another company I just want to mention briefly is Bravura. It's up a little bit. A proposed return of capital to shareholders. They did a guidance update on the 15th of July. Share price didn't really rally after that, which I'm surprised with. Well, sort of surprised with. So this is some interesting vibes within this particular announcement. This could have made it into my top 5, particularly the share price had rallied a little bit more, but it didn't. I actually had a look at the share price because I thought maybe the market would like this, because Australians love dividends and return of capitals. And I'm more than likely I do have a trading position in this company, and I more than likely will sell out before they release this capital to shareholders, because I don't care about the dividend or return of capital. But what I actually did find intriguing about this, and why I thought the share price might have run up, is why they're doing it. Here it is. Where is it? It's somewhere here. And it wasn't this hard to find. To do with surplus. Can't believe I can't find this. Maybe just pause for a second. Okay, I can't believe it. It was in the first bit of the third paragraph. As a result of the March 2023 capital raising, which was well over a year ago, and the scale and pace, this is probably the most important thing, and the scale and pace of Bravura's transformation, the board has determined that the business is overcapitalized. So they did this capital raising, and they don't need the funds. They probably did too much of a capital raising, and the reason why is because they've transferred much quicker than they thought. And this has been quite evident in a few announcements the company has released in the past 6 months, that they used transforming, but they were turning around a much quicker pace than they originally anticipated. And that's why I thought the share price might take off. This was more confirmation. So there's still a fair bit of negative sentiment. So even though it really looks like the company is turning things around, I think there's proof for that. The share price is finding it really hard to go on a rally because of all those shareholders who bought at higher prices in the past who just selling out. That's all they're doing. Share price has increased a fair bit, to be honest with you. But I just thought there would be, and you can see the selling. This one on the 15th of July, when there was that guidance update, really good announcement. The share price, you can see that one day candlestick, a lot of selling. And even today, a lot of selling. And the reason there's a lot of selling is because shareholders have bought in the past at higher prices and they're just looking for an excuse to get out. And they see the share price rally and they go, oh, now's the time to get out. So we need those shareholders to get out. We need a clean slate. And when you get a clean slate, and if the company releases really good financial results, I think that's the time the share price of this company might just absolutely go off. Now, a few things. I'm not the biggest fan of return of capitals. I would prefer the company put that to other uses. If they have any debt, that sort of thing, pay off the debt, acquisitions, that sort of thing, research development. Yeah, I'm not the biggest fan of return of capitals because it's not free money. The company will, if the company gives back, was it $75.3 million to shareholders, the valuation of the company will drop $75.3 million. It's not free money. And that's the main reason I'm not a fan of return of capitals. And what they're saying is, we don't know how to use this money, so we're just going to give it back to you. You can do more with this money. You are better capital allocators of this money than we are. And to me, that doesn't give me any trust or faith that management know what they're doing. If they think that you are a better allocator than they are, because the management of a company should be the best allocators there are. It's why Warren Buffett never gives dividends back to his shareholders, because his reasoning, I'm pretty sure he said this before, his reasoning is, well, I should be a better capital allocator than you. Who would you rather look after your money, yourself or me? And I have a history of doing really good things with your capital. Anyway, that's his reasoning for not giving dividends back to his shareholders. And it's really valid reasoning. Now, another argument against that would be many management teams are pretty bad at capital allocations. It is the most important job of management. What do you do with the money? You can see here, they raise money. They don't know what to do with it, so they're just giving it back to shareholders. Okay, so that's just me. I probably would prefer them trying to do something else with it. Why not? All right, so let's have a look at some of your comments. We'll start off with Liam Jones, who asks, I was wondering if you could explain the details of an SPP, more specifically for ZIP. Why are they doing it? What benefit does it gain? And when the new shares are issued, will this raise or lower the share price? Let's go to ZIP. Now, I do have some shares in ZIP. I'm trading ZIP, and I'm going to partake in this capital raising. Share price right now is $2.03. This share purchase plan is $1.50. Am I wrong in thinking for some reason I've got $1.53. $1.56. Okay, I wasn't that far off. So, why am I participating in this share purchase plan? Share price now $2.03. I have to pay $1.56. There's right there a premium right now in the share price of 47 cents. So I could take part in this capital raising, sell my shares now, get the shares at $1.56. And this is really intriguing. The share price is so much higher than the share purchase plan. So that's the first thing about this. Let's answer some of these questions. So what is an SPP? It's a share purchase plan for shareholders. So instead of a placement, which is for institutions, this is for shareholders. So I'm pretty sure it's the SPP. SPP stocks, share purchase plan. Pretty sure that's what it's called. Share purchase plan. Next investor says, offering that allows existing shareholders of a company to purchase additional shares. CanStar says exactly the same thing, to try to quickly raise money for existing shareholders. If you go to this particular announcement, usually there's a cutoff date. Here we go. Under the SPP, shareholders who have a registered address in Australia, New Zealand on ZIP's register as at 7 p.m. on Tuesday, 6th of July. That's 16th of July. Yep. So you've had to own shares at that point. You have the opportunity to apply for up to 30,000 new shares. That's the question I'm going to do. I might apply to get quite a few shares because of significant discount. So again, $1.56, current share price is $2.03. I'm not sure when the end is, when we get these shares. Here it is. There's a timetable here. So it's the end of August. So share price could drop 50% in the meantime. So there is a risk there. Share price could drop. However, the chart looks pretty good. Okay, so let's go back to some of your questions. Could explain the details of an SPP. Have I done that enough? So you have to own shares in the company at a certain date. That date is 16th of July. Have a look at your documents, blah, blah, blah. You can apply for $30,000 worth, that sort of thing. Doesn't mean you'll get all that, because if they oversubscribed, I would assume they'll scale back. Now, I've not read that, but that's what I'm assuming they're going to do. Because there is a possibility, because the share price is so much higher right now, they're going to get a lot of applications, and I assume they will scale back. And then you just get a check in the mail or something. I haven't seen them saying that, but I assume they will scale back. I'm just assuming that. So hopefully that's enough information about the details of an SPP. Why are they doing it? Because they think, well, actually, instead of assuming, they should have actually mentioned why they're doing it. Where's their initial? There should be an announcement here where they actually mention their reasons for doing it. It could be to pay down debt, could be to provide extra money for growth, that sort of thing. They haven't got. Usually, there is a pretty big document somewhere here. Disclosure document. Probably not in that. Maybe in the ZIP share purchase plan announcement. And sometimes they'll have like some numbers. I will definitely go through this document. Scale back. In fact, here's a scale back they mention here. ZIP may scale back applications if it receives applications of more than $50 million. Yeah. So I'm glad I assumed that because that was right. And there should be somewhere here about what they're going to do with their funds. And I can't see it on quick looking. Talking about scale back. Purpose. There's a purpose. I saw purpose of the SPP. So here's why they're doing it. So this is your answer to your question. No, they haven't got any information there. They just want to raise 217 billion. Look at the risks. Yeah. I'm surprised they didn't do. A presentation, because in the presentation they would tell you why they're doing this. No, I can't see anything on why they're doing it. Doesn't mean they haven't provided the reasoning. Maybe it's this one. And I'm just going to try to find. Okay, so they've given a little reason here. Strengthens the balance sheet, resets the capital structure, and provides additional flexibility and liquidity to pursue further growth. So it probably has to do with debt. Strengthens ZIP's balance sheet is, yeah, that's something to do with debt and liquidity to pursue further growth. So that's probably all I need. That's the reasons behind the capital raising. What benefit does it, why they're doing it, and what benefit does it gain? I think the benefits for the company, and put it this way, the whole reason equity markets exist really is to provide easier access to capital or money so a company can grow. That's the whole reason behind the stock market. Now, the first ever stock market, I believe, was in Netherlands, 1600 so, and at that point in time, was it on a bridge? I have a feeling it was on a bridge, and it was only one company traded, and that was a Dutch East Indian company. In fact, I'm just going to Google it. First stock market. I'm pretty sure it was Netherlands. First stock market. Yeah, Dutch East India Company, trading through the Amsterdam Stock Exchange, 1602. Yeah, I knew it was 1600s, and I'm pretty sure it was on a bridge. I'm not sure if the stock exchange was on a bridge, but yeah, I'm pretty sure it was on a bridge. And it was only one company. Just think of that. Only one company. Yeah, I looked at this many, many years ago. 1602. But anyway, whole reason of equity markets is to raise capital. Yeah, so these sort of capital raisings from companies like ZIP happen all the time. So eventually a company or ZIP, hopefully ZIP will become profitable, generate a lot of cash flow in their operations, so they never have to do a capital raising again, and then they can give dividends back to the shareholders, stuff like that. So that's why they're doing it, is to become a stronger company and to grow for the future. And when the new shares are issued, will this raise or lower the share price? Okay, so here is where it becomes tricky. It could go either way. So think about this. So think about, I decide to apply for $30,000 worth of shares, and I already have $30,000 worth of ZIP shares, and the share price is $2, and I can get these shares at $1.56. I go, well, I could sell my shares right now and make a big profit. There's an arbitrage there. So it theoretically should put a pressure on the share price. Should, because you will have selling by those people who have participated in the share purchase plan. Not all of them, but some will definitely sell when they realize how many shares they're getting, and they can immediately take some profits. So I wouldn't be surprised to see the share price dip back. But very, very interesting, share price has increased since they announced this the capital raising, which tells me there is a bit of strength in this company right now. And the chart tells me that as well. That's the whole reason I'm trading ZIP right now. The chart shows strength. Share price has got above $2 right now. Okay, that's the only question I'm going to ask in today's video. So feel lucky, Liam. Okay, anyway, that's all I got for today's video. Have a good day. I hope you've enjoyed this quite a day on the ASX in terms of announcements. If you have any questions, any thoughts, leave those in the comment section of this particular video and see what I'll be able to do. In fact, I should answer all your questions, reply to your comments in due time. You might have to wait a few weeks, but I do like to go through all your comments. Okay, so that's it for this video. Have a good day. Bye. And don't forget, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.